You got two types of insurance, generally speaking. So you got term over here, you've got permanent insurance over here. Okay, now some people say there's term and whole life. So that used to be the case before there were other types of permanent insurance. But so term, you're going to want to know about like increasing term. You'll want to know a little bit about decreasing term and for whom this applies. Like a friend of mine, when he started his dental practice, needed a $700,000 loan. You better believe that the part of the condition of extending that loan to my friend, who is my dentist as well, made sure, or not made sure, but they said, we're not giving you a loan unless you got a decreasing term policy with us. And it's going to be a 10-year loan. And every year, the face value is going to start out at 700,000. I think it was in that ballpark, and it'll drop every year by 70,000, the face value, because you're going to be paying off $70,000 a year in the loan. So we as the bank don't have as much on the hook, right? Or we're not on the hook for as much. Okay, so where does increasing term and where does decreasing term come in? What's the story with like level term? And so when I'm saying these things, you guys want to be taking notes, and they don't have to be completely detailed notes, but we want to have notes to the effect of like, well, Sev said that we should probably know about this stuff. Okay, so that's what you want to be taking notes on. Then you go back and then you deal with your own flashcards or note cards or your virtual cards, whatever you're doing. Okay. On the permanent side, then you've got whole, you've got basically you got whole and universal policies, and then you can have like a variable under universal. But the whole life, fairly straightforward. There's not too much in the way of questions that they can ask you. Whole life is fairly simple. Penn Mutual, whatever, just use Penn Mutual as an example. They'll just say, hey, look, here's the quote. It's 10 grand a year. Pay us and we'll cover you until the day you die, until your age 100 or the day you die, whatever is sooner. And if you stop paying the premiums, that's it. Then you don't have coverage anymore, and we pay out the cash value to. Universal is a little different, and this is where the confusion and the problems might come in on the board exam part of it. Yeah, and so where it comes in is that they're like, what's going on with the premiums? So the premiums that go into these policies, just think of it, they go in 3 different directions. And again, I'm mentioning this because I know you guys are 2 months away, but I think if we can lay a pretty solid framework or a foundation about some of these more confusing topics, I think that'll be good for all of you. But just keep in mind, like, what's going on with the universal policy is that the money, the premiums that are being paid basically go in 3 directions. So you've got administrative expenses, or we can put like commission charges in here. Okay, that's kind of cut off there or whatever, but yeah, commission charges. And then we're going to pay for the actual insurance, the mortality expenses. Let's just call it the insurance charge, the actual product of the coverage of the life insurance. All right. So because here we got to keep lights on, administrative, we got to pay the sales guy for the commission or whatever that comes out to be. But now we've got to pay for the actual coverage here. And then anything that's left over goes into the cash value. In this cash value, we're going to earn, generally speaking, we're going to earn interest, and the company might decide to pay dividends. Okay, like Penn Mutual has been around for 10 million years. They've been paying dividends, I think, since they opened up in like 18 whenever. Okay, now where do we get into trouble with the universal policies? That if we stop paying the premium, the whole life policies, really, again, just generally speaking, we stop paying the premiums, then that's it. The policy lapses. They pay you out whatever accumulated cash value you got here. Universal policies can continue on until all those premiums are used up, and then that thing blows up on the client. For example, I'm running financial plan for client right now. The husband bought a universal policy back in like in the 1988. Okay, and premiums have been like $200 a year. He's much younger, obviously, almost 30 years ago. They were a lot less, $200. For whatever reason, stop paying the premiums. And they just came on as clients. So I didn't do this to them, and I certainly was not in business in 1988. Now the premiums, I believe, are going to be, starting this year, like $6,000. And next year it'll be $8,000, right? Because he's, now he's in his mid 60s. So watch out for that type of thing on the board exam, as far as like universal policies and where they come into play. They're gonna give you a scenario where it's like another newlywed couple, and husband and wife just started a business. They think they're going to do well, but there could be times where where business is going to slow down, just like any other business. And they need the flexibility, and flexibility is the key term with universal. So like I mentioned, whole life, yeah, you could get a question on it. Universal, I'd put my money on having more questions being asked about universal policies, because the flexibility, because of it's a lot more complex than a whole life policy. We can actually introduce like sub accounts so that we get market performance, not like performance we had today, although it was a pretty nice rebound today, I got to admit. Okay, so more complexity. If you're going to spend a couple hours studying up on permanent insurance, you're going to spend most of that time on universal policies.